everyone, let me introduce you to my wonderful loan originator, Tracie Smith. Tracie is in this business since 1997. She is not only the frontliner keeping up with mortgage industry, but she managed all the phases of the residential mortgage process. With over 20 years of experience, Tracie excels at providing home buyers with knowledge and support necessary to make their decision. She has featured by local and nationwide media, so you can find her everywhere. Yahoo Finance, Mortgage Professional, American Magazine, Digital Journal, ESPN Radio. So just check her out and see how awesome she is.
I love that. Thank you.
It's so exciting to have you here, Tracie.
I know. It's so awesome. I'm so glad we connected, and you did such a great job introducing me. But I want you to, since it's your market, your town, your city, I want you to just talk a little bit about yourself too, so people know how much experience you have. It's so awesome.
Okay, let me find the words, because for me it's much easier to talk about people around me.
You're a bad realtor, like a badass realtor. You could do it. Come on.
Yeah, so I started doing real estate, actually getting my license in 2009, when was the crash, so everybody was jumping out. I jumped right in with all the foreclosure, short sales, and craziness in that market.
Yeah.
But before that, I was an investor myself here in United States and in Romania, my country back home. Okay. So I'm doing real estate since I was 20 years old. So I got like 30 years experience.
Oh, you're not supposed to say that. It gives away your age. No, I'm just kidding.
Yeah. Well, I'm not that old, right?
I know.
My 25 years. Come on.
I know when someone says I've been doing mortgages for 20 years, I'm like, no, God, it's crazy.
Yeah. So I went through everything. I saw all the craziness, and right now you see the market is shifting a little bit. So
yeah,
just one second. I am so sorry.
That's okay. And I'm so glad you asked me to be on the call with you, because you have a lot of questions about lending that you get from your clients, and I definitely want to be a resource for you and for them. So I'm going to have
Thank you so very much. I always like to educate my clients and to educate people, doesn't matter if they're buying or selling with me, being a realtor, being a professional, my duty is to serve,
Yes.
I feel like it's our job to educate them.
Exactly. So I'm going to let you fire away, see if I could handle all your questions.
I got a lot of them.
All right, let's
go. My clients, they hit me every day with tons of questions. Let's start.
Okay.
Number one, what is the difference between pre-approval and approval? For most of my clients, seems to be the same meaning, and all the time I'm explaining them the difference, because they think if they are pre-approved, they don't have to do anything. They're gonna get the final approval. And also, how do we get qualified?
Sure. So there's actually three different things. There's pre-qualification, pre-approval, and then approval. So I'll kind of go through really quick the three of them. So pre-qualification is the most basic, where you're really just having a phone call with a mortgage lender, or you're meeting them in person, and they're just going over some questions with you. And based on your answers to those questions, they're giving you an idea of what your pre-qualification would look like. Okay. When you're working on a pre-approval, it means that you're providing your documentation. So your income, your assets, we're reviewing your credit report, we're running automated underwriting. So we're really going through that process where when you go and find a home, we have enough information to get your loan into underwriting and close it very, very quickly. We could close a loan in 8 to 10 days if we had to, right? Depending on how.
Oh, that's very nice.
Yeah, how much information we get. And then you could also do what's called a TBD approval, which means we actually go through the whole process of submitting the loan to an underwriter, and they underwrite the loan, but on a TBD or a to be determined address. So that means the buyer's actually shopping around, having something from the underwriter saying, I've looked at all of your information, go ahead, you're already ready to buy. We just have to wait for like the title report and the appraisal and those things to come in. So those are the three differences. The process is really easy. Every lender has their own process. For me, obviously, because I'm on the West Coast, right? I'm originally from New York, so I'm familiar with the East Coast, but everything is done securely online. So your client would get a link that they would go to, they would complete their information. It notifies me when they're done. And it also gives them a secure portal where they upload their documents that come to me securely as well. From the time those documents come in, it takes about 2 to 3 hours to work up options and get the pre-approval going for them. So it's super quick.
Oh, nice, nice.
Yeah. Did that answer your question?
Yes.
Good.
Now, credit seems to play an important role when applying for mortgage. What are your credit requirements?
Absolutely. So again, I'm always going to say each company is different because they are. The previous company I was working with, we had to have a minimum of a 580 credit score. But at Nexa Mortgage, you could go down to a 500 credit score, which is great.
Wow.
Yeah, it's great for people that have had some kind of circumstance that's happened in their life that maybe they haven't been able to get back from. And so a 500 credit score, we could do an FHA loan, which would require a 10% down payment. Or if you are VA, I don't know if you handle a lot of like veterans or
I don't have a lot, but I did have.
Yeah, I mean it's a great loan for people that have served our country, but you could go down to a 500 credit score and they would still have no down payment,
Wow.
which is great. And then when you're talking more about conventional programs, the minimum is a 620 credit score that you need, so you can go down to a 620. And then when you're talking like jumbo loans, where you're going over that loan limit that we talked about of in your counties, it's like that 726 200 loan amount. Then you're probably around like a 680, maybe a 660. So you can still buy a high priced home, even though your credit scores are below a 700, but interest rates are going to also be different, right? Because the higher FICO score, the better interest rate you get, because it's less riskier for that investor because you've shown that you've been able to manage your credit over history. So that's why interest rates and credit scores, kind of go hand in hand together.
Yep.
Yeah.
How about income? I know the income is another important fact when applying for mortgage. Do you have any no income verification program? Because, sometimes I have some self-employed people, and or investors which they are looking, to buy like rental properties.
Yeah.
And it's much easier for them to.
Yeah, and it's not only that too. It's people that even like worked, and because of COVID, maybe they've lost clients, right? Their business had to shut down and they can't document 2 years of tax returns anymore. So we have access to what are called non-QM loans or non-qualified mortgages, which are more of your non-traditional type of loans, which include no income and no ratio. DSCR, do you know what that stands for?
I heard about this program. I think it's based on the income of the property which you are buying.
Yeah, so it's perfect for investors, for your clients that want to buy an investment property. You don't even have to be an avid investor. You could be a first-time investor, and you don't have to you don't show income, you don't show debt ratio, you have to have some reserves. It requires a larger down payment, like all investment properties do. You're going to be somewhere around like 25% down payment, which is even a traditional investment property. And they use the projected rent from the appraisal, or if it's already rented, what it's been renting for. And as long as that can offset the new mortgage payment by a certain percentage, then you would qualify to get that loan. So what I tell people is, think about it. If you're doing no income, no debt ratio, you're going to have higher interest rates, right? So people sometimes are like, wow, the rate's high, but they're lending you money, not even knowing if they pay it back. So and most of those loans for investors are short term, right? So like 2, 3, 4 years where you're going to maybe flip the property. And we have properties like that are fix and flip for investors. You can do self-employed with 1 year of tax returns. You could do 1099 only, P&L only. I mean, the opportunities are endless now. It's just like, it has to meet everything, right? So your credit, your income situation, how much of a down payment you have. So we kind of mush all of that together and see what product works best for you.
And you're gonna cover the gap, like let's say you have lower credit score or no income, you know, sometime will be covered by a higher interest rate.
Yeah, I mean, just those programs in particular will always have a higher rate. I mean, regardless of credit score, because again, you know, they're lending on something that they can't document. So what is a little bit better is a bank statement loan for people that are self-employed. So they'll show either their personal bank statements or their business bank statements, and we can use the deposits that they've made, because most people that are self-employed have a lot of expenses that they write off. Right? So their tax returns show a very small amount of income that they've earned, but their bank statements show a lot of deposits coming in. So we can average their deposits and use that as income as well, which is another way to help people that are self-employed.
Yeah. And yeah, you know, I have my son, he will be 19 years old this year. And he's looking to buy a property. Of course, he has young score. I mean, his credit score is 720, you know, but it's young, is like 1 year or more than a year. Yeah. And same with the income, he doesn't have 2 years of income tax. What you recommend for him?
Is he self-employed, or is he self-employed currently, or?
No, he is working on W2.
Okay, yeah, so if you, well, it depends if he wants to purchase a home for himself to live in and not as an investment property. The FICO score is good, so you don't have to have credit for a really long period of time. Some programs have guidelines like that, but a traditional loan wouldn't. His income, we would just try to look at his W2 and his pay stub. And what I'll normally do is take what his income is and then work backwards and say, based on what you're documenting in income, this is the maximum mortgage payment, which means this is the maximum sales price that you can go out and look for. So you're never too young to buy a house, right? I think actually you have to be 18, but I talked to someone yesterday, he was 23, he was a firefighter, he lived in Washington, and he is gonna purchase a home, you know, $25,000 he was able to save up from working, and it's going to be his first home that he can then turn into an investment and buy more properties and invest in real estate. So
my oldest son is 25 years old and he bought 3 properties until now. He's living across the street from me in one property, and the other ones he rented out.
It's awesome. You build wealth through real estate. I mean, it really is the best way to build wealth for your future. That's awesome.
Yeah. I think he copies us.
That's great.
Okay. I can see that you have many types of loan, many products are available. And what's the difference between them? Like, I know that when you put down like 5%, 10%, you know, below 20%, you are happy because you don't need that much down payment, but in the same time, I know that you gotta pay the PMI. Can we talk a little bit? What's the PMI and why do you have to pay?
Yes, absolutely. So I'm gonna do category like loan types. So there's one loan type that's called VA that we spoke about. That is for people that are either active or retired military. There's no down payment and there is no PMI, even though there's no down payment. So that's one type of loan. A second type of loan is called FHA, which is a government loan. The minimum down payment is 3.5% required from the borrower. That does have mortgage insurance, and that's paid monthly. And you cannot get rid of that mortgage insurance unless you refinance the home or sell it, right? So you'd have to refinance it into a different loan type. It stays on the loan for the life of the loan. The reason people go FHA is if you maybe have a little bit of a lower credit score, or your what's called a debt to income ratio, right? What you make as income versus your debts you have. If that's a little bit higher than other loan programs allow, we would look at an FHA loan for someone. Next loan type, conventional. So if you hear conventional financing, that has a minimum down payment of 3% if you're a first-time home buyer. And a first-time home buyer means that you have not owned a home in the last 3 years. And then you could do 5% down, 10%, whatever you want. But on that loan, if you put anything less than 20% down, you will have PMI, or private mortgage insurance. And the reason you're paying that is it protects the lender, because you are putting a little bit of money down, right? You have less skin in the game. And so they want to make sure that they're protected, that if you default on the mortgage, right, that private mortgage insurance is ensuring basically like the payments.
It's going to cover.
Exactly. So, and again, you could put down as much or as little as you want, but that's really how it goes by product is what it is. So it's FHA, VA, conventional. And then of course you have your jumbo financing, which is the higher loan amounts that go over the county loan limit.
But regarding FHA, all the FHA loans, they cannot be refinanced, or there are some of the FHA loans or programs which you can refinance later on and eliminate the PMI.
Yeah, you can so if you got an FHA first mortgage and you didn't have any kind of down payment assistance or anything tied to it, you could refinance that FHA loan whenever you wanted, right? But in order to get rid of the mortgage insurance, if you refinanced it into a conventional loan, your loan to value has to be what? To avoid mortgage insurance, it has to be 80%, right? So you have to have enough. So if someone buys a house FHA and they only put 3.5% down, you kind of have to wait until the home builds appreciation. So you can refinance it into conventional, but have 20% equity. So you have to go from, 3.5% down to that 20% equity position to have the mortgage insurance removed. But it's possible on any FHA loan that doesn't have down payment assistance.
Oh, okay. Because I remember I had a client, well, it was like 10 years ago. He was looking to refinance to get rid of the PMI, and he couldn't refinance because his loan didn't allow him to refinance. It was FHA, but I don't know why.
Yeah, you are always allowed to refinance, but you have to qualify for the refinance into a conventional loan. And the guidelines are different. So it might have been just that FHA.
So maybe. So it was not the loan itself, like because it was FHA loan.
No, it's because of the
his situation, probably.
Yes.
I understand.
Exactly.
Okay. Okay, so we talk about the mortgage insurance, the PMI. Okay, how about the interest rates? We know that they went up in the past year. So we were in love.
I can tell you, yeah, April of 2023, I mean, I'll never forget. It's our market just came to a screeching halt, with inflation data and, just because of everything that was backed up because of COVID and supply and demand. And so it honestly, it went up. I mean, I was offering people those rates you were seeing, like the 2s and the 3s and the 4s and 5s, and we're not at that place right now. But what I try to show people is like, look at history, right? So that wasn't common.
Historic.
We have been in this business for a really long time. When I started, the rates that I sold were 16% on a mortgage, and people still bought houses. They still did refinance loans. But
in 1981.
Yeah. Yep. So I think that
my neighbor bought with 16%. Yep. I couldn't believe.
That's what it was. And there was no high cost limits. I mean, we were charging a lot of points on loans. It was so different. And now I think it's because the news is so involved and the media is so involved, and it's, rates were low, but that was not normal. So I think it's going to take people a little while to understand that what we're in right now is more normal. They shot up, I mean, over 7% right now. I'm seeing them back down with my company. I priced one today. We're in like the 6.5, or even FHA, I could get it down in the 5s right now.
Oh, wow, nice.
Yeah, you could buy down interest rates still. So it's not as terrible as people think. And if you really like sat down and did the math between, and I'm going to show you something in a second, kind of what that difference in savings is between 6.5% and 5.5%. Yes, it's higher, but it shouldn't take you out of the game of wanting to buy a house.
Yeah, Tracie, but you know, I'm trying to explain my clients what we had last year was unhealthy because, you know, I made offers, I put 90,000 over the asking price, right? And we didn't get the property. The property was sold with 120,000 on top of the asking price. The property didn't appraise out and the client had to put 100,000 from out of pocket, right? And I think they were losing a lot of money at that time, you know.
Yeah. Yeah. I mean, it was
now the interest rates are a little higher, but there is not that much competition. And if we wouldn't stop that competition, right now, probably we're going to put 300 over the asking price or what?
Yeah, exactly. You're exactly right. So that's the thing is that people that are buying now are not having to go over asking, right? Or take more money out of their pocket. Yeah, but they're going to pay a little bit more in interest. And if you think about 2% over like the life of the loan, right? That's why it's so important if people are even thinking about buying a home is let us do a consultation. Like, let's look at the numbers and what works for you, because you may be surprised that the number may sound high, but it may not change the situation or the payments that much, right? So, but interest rates, I mean, this year is going to be rough. It really is. 2023, it's probably going to be about where we are. There's another Fed meeting in February to see if the federal funds rate will go up again, but they're saying hopefully that in the next year, right, 2024, 2025, we'll get back to lower rates, but I could honestly say I don't think that they'll ever get back to a 2% or a 3%, because look where it's led us, right? It's led us to this point that we're at now, and they won't continue that cycle. I don't think.
Yeah. Okay, let's talk a little bit about how we can get a better rate, how we can lower our rate, and what programs do you have?
Yeah, so I'm gonna actually share my screen really quick for people.
Thank you so much. So
yeah,
I
think everybody, I think right now is talking about the 3-2-1 buy down. Actually, I'm gonna change screens really quick here so I can do a new share. Let's see. Share screen. Okay, can you see my screen okay?
Yes.
Okay, see the calculator, right?
But I'm gonna put my glasses.
Okay, good. So this is, if you hear something out in the market saying like 3-2-1 or 2-1 or one thing or buy down, or that's what the example of this is. Okay, so I just want to take a quick example. You were saying in your market, maybe an average sales price is 500, 550. I'm going to use 600 just to show people a higher example. Okay, so with 600,000 sales price, a loan amount of 570, which means it's 5% down payment. And just current market rate, let's say, is at 6.5%. It's a 30-year loan, and there's obviously 12 months in a year, so they make 12 payments. The monthly principal and interest payment is going to be $3602. So that's what you're paying in principal and interest on the loan. Okay. Then we talked about your property tax rate in your area. You're going to have homeowners insurance, which is similar to like a renter's insurance, or it protects the house. And then you're going to have mortgage insurance because you're only putting 5% down. Okay. So you're going to have to take the principal and interest payment and you're going to add it to all of those other things, which is going to give you a total payment in this scenario. And I'll highlight it right here in red, of $5288 is what the normal payment would be if you only put 5% down. Okay, so right here. So let's look at this. So a 3-2-1 buy down, what does that mean? It means the first year of the mortgage, you would actually get a rate at 3.5%, which is 3% lower than the current market rate. Year 2, 4.5%. Year 3, 5.5%. Year 4, it's going to go back to what we locked you in at, current market, right? But what does this do for you? So you basically have a savings in your monthly payments the first 3 years. Okay, so look at that. It went from 5,200 to 4,200, right? So you're saving $1,000 a month in year one, $700 a month in year two, $366 in year three. Now, how could we make this work? Now, in this example, you're going to see here, what happens is the seller of the property gives what's called a seller credit or a seller concession, right? And that's something you, Daniela, would negotiate on behalf of your client, right? Now, if you're only putting 5% down, the maximum concession that you can get from the seller is only 3%. Okay. Now you see in my first example, we need 4.2% to make this example work for the buyer. Okay. So what happens? We would only be able to do the 2-1 buy down, which means year one is 4.5%. Year two.
I have a question here.
All right, please.
So right here, if you're gonna take a 3% from the seller, and can you put the rest 1.2% as a buyer?
No, it has to come from like a third party from the seller.
So cannot come from me.
No. So if you as the buyer are going to buy down your rate, you're going to do it in a little bit of a different way, which is called a discount cost. But in this particular program, it's going to come from a seller concession.
Okay. So
Yes.
just from the seller. Okay.
Yes. So we would,
thank you so much for clarifying.
yeah. So we would change the borrower and say, hey, let's do a 2-1 buy down. You're still saving, I mean, a ton of money, right? And the cost is only 2.16%. So Daniela, if you negotiated a 3% credit, you can use 2.162% for the buy down and use the rest of it to go towards their other closing costs. Right?
Oh, wow.
Which would be great. So you could cover almost 1% of closing costs, plus they're going to save $700 in the first year of the payments every month. And then
So it's
$360
gonna be like 7,000 a year.
right here,
plus-
$8,500 for the first year and $4,300 for the second year. Okay. Now, the cool thing about this program is there's no prepayment penalty. So if you're in a lower rate for 2 years and then rates drop, you can refinance the loan if you qualify, lock into current market, hopefully, which would be lower at that time. And any money that you have left into the account goes towards principal reduction. So you don't lose that.
I love this. That's why I love this program.
It's so great.
Because you don't lose the money. But I think when you as a buyer buy down the interest rate, then if you refinance later on, you will lose the money, right?
Yes.
Okay.
Correct.
Nice.
Because when you buy, so in this example, if you just bought down the interest rate on your own, right? Like let's say you wanted to go from 6.5% and to 5.625, that could cost you, I'm just going to do an example. I'm just going to say 2%. Okay. Now you could get that from the seller still, or as a buyer, you can bring that up front to the closing table to have a lower monthly payment. Okay. Discount points, I don't know. I always talk to the buyer to see what their intention is, because sometimes it's not worth you taking money out of your pocket to save.
If you sell next year or in 2 years or in 5 years, right?
Exactly. So
but if you want to keep the house for 30 years, then maybe it's worth it.
So what I'll always do is a breakdown of like a cost analysis of what the cost would be versus the savings, and then how long it would take them to recoup the money that they're going to bring out of pocket. Yeah, so this is something we could just run with people. If you have clients that want us to do this scenario, it kind of gives, an idea of the information, and we could go ahead and get that done for them.
I really love this 3x2 buy down or the 2 buy down by 1 buy down program.
Yeah,
they are very, very nice.
Well, because
especially that you don't lose money.
Yeah, and you work with sellers too, right?
Yes.
Okay, so think about it. You have a seller that maybe has had their house on the market a little bit, or maybe it was an expired listing and buyers weren't buying their house. I mean, you could say, hey, Mr. Seller or Mrs. Seller, as a strategy, instead of reducing the price of your home, give a credit to the buyer for them to be able to do this program and have them afford the payment to where you could sell your home faster. And so that's what we're trying to stress to listing agents, to where don't drop the price 40 grand, give a credit of 20 grand and you'll save 20 grand in your pocket and help a buyer save money in their payments.
Yes.
Yeah.
You see, always situation, they are different from client to client. It's always, good to talk with the clients and to see what their intention is and to find out as much information as you can from them so you can help them out.
Everybody's different. You and I are different. We're going to qualify for different things. There's no way you could blanket something for everybody. You have to talk to people individually and find out what their situation is.
Okay, so we were just talking about sellers. So I have some clients which they want to sell the house and they want to buy another house and they don't have enough money for down payment or the house doesn't sell that fast. Do you have an option for this, like bridge loan? Or
Yes. It's a bridge.
Can I talk a little bit?
Talk about a bridge loan? Yeah. I mean,
yes,
exactly that. So it's bridging you from one house to the other. And it's giving you money that you can use to put down on the new house without having to close the sale of your existing home, right? So generally you'll have your current house listed for sale. On the new house, let's say you need $100,000 and you know that when you sell your home, you're going to be able to net that $100,000. But you don't want to sell your home until you know that you're in a new home, right? You want to make sure you keep your home, you're in escrow, you closed on your home. So you'll use the bridge loan to do it on the new purchase. And then once you sell your house, you just pay that bridge loan back. So they're usually short-term loans, within like 6 to 12 months of being paid back. You want to make sure, obviously, that you sell your house, because if you pull it off the market, you'll default on the loan, which you don't want to do. Because
how about if you cannot sell it? What's going to happen? Let's say, God forbid.
God forbid, you're going to figure out a way to pay that loan back, the bridge loan, right? So you just have to know that if something happens or changes, you have to have the means to be able to pay that bridge loan back to the investor, because their collateral is your house, right? So they collateral.
So they are collateral for the new home, right?
No, well, generally what they do is some cross-collateralize, which means you have to have enough equity in your home that you're selling, right? And then they take the home that you're buying and they'll cross-collateralize them. So they'll use the home you're selling and the home you're buying and take a percentage of that total value to figure out how much of a bridge loan you can get.
So in case you're not gonna sell your home, you can lose both of them.
Yeah, you don't want to do that. But I have one investor that it's a 12-month term and there's no payments in that 12 months. And the debt to income ratio is not affected by them keeping the house, because they'll do the first mortgage and the bridge loan with me. So this way, they don't have to worry about not qualifying because they are keeping their other home. They don't have to rent it out. They could just keep it listed.
Okay, what is the loan estimate and what cost will be associated with the mortgage?
That's a good question. So once an application is triggered on a loan, so let's say, for example, a client goes into contract, within 3 days, we have to deliver what's called a loan estimate, which is an estimate of the closing costs. What I try to do is, if I can, get the exact title fees and escrow fees, but sometimes there's a delay in that. So we'll just probably use estimates at the beginning on the loan estimate. That's why it's called an estimate. On the mortgage side of things, most of the closing costs are third-party fees. So as the mortgage lender, you're going to see either an underwriting fee, or sometimes we even waive that. So probably anywhere from if we do with an underwriter fee, it's maybe $1,200. If we waive the underwriting fee, you're probably at $200, right? So on the lending side, that's just through my company. My last company, I was charging $1,700, $1,800 in lender fees. The other things are third party. So the appraiser is a third party. The processing company is a third party. The title company, the escrow company, the notary, the recording of the deed. So those will be closing costs, but I always tell people assume I don't know if your county is any different, but we average about 2% of the sales price. Do you have any taxes or anything, you know, in your state that are
Yes, that's why I always tell my clients, my buyers, to have ready like 3%. You know, I always prepare them to have more money, you know, than to have,
Yeah, every state
So-
varies. So there's either sometimes like state taxes or transfer taxes, or so, you know, depending on the state. And again, we'll give those estimates up front so you know how much money you have to prepare to have when that close of escrow date comes.
because you see, in our state, this year, you pay the property tax for last year.
Mhm.
Okay, so at the closing, the seller has to prorate, to give you credit, to give the buyer credit, that portion of the property tax which he didn't pay, not because he didn't want, he didn't even have the bill out.
Yep.
You know, and sometimes it's true, instead of bringing 3%, maybe they have to bring just 2%. But again, I prepare them with 3% because you don't know that situation and how much credit they will receive from the seller.
Right. And like we talked about, if you only put 5% down, you could get a 3% credit from the seller also, which sounds like that would cover pretty much all of the closing costs. Like the credit can't exceed your closing costs, but if you were able to negotiate that and play around with it, it's just less money that the buyer needs to bring into the closing table.
Yeah, if you are buying in the area where is buyer's market or normal market, but let's face it, we still have some areas where is seller market.
Yeah.
Even right now, multiple offers.
Multiple offers. Okay.
Yeah, so you cannot negotiate things like this.
You know what though, sometimes people they maybe negotiate a little higher in price, or you know, to get a credit back. I mean, again, every situation is different, and that's why you need a team, right? Daniela is part of the team. I'm part of the team, where we have to just figure out, do you need $5,000 somehow? How can we try to get that, right? How can we work around that? Or do we look at houses that have been in the market a little bit longer in a different area? Everybody's situation is different.
Yeah. Okay, now I know that you didn't, or probably we didn't hear too much about refinancing in the past few months, you know, because if the interest rates went up, you know, people, they don't want to sell. That's why we have very low inventory. You know, this is one of the reasons people, they don't want to refinance. But I know that a lot of people, they have a lot of equity in their home. So some of them, maybe they are thinking to remodel their home, or to buy a new car, or to do something different. I don't know.
An investment property.
Exactly. Can they take a credit line from that property without to refinance the mortgage they have right now with, let's say, 3%?
Yeah, so there, it's called a home equity line of credit, or with the company I work with, there's even fixed second mortgages now, where sometimes people didn't want an equity line that's what's called revolving, like a big credit card, right? But it's still at a lower interest rate usually than what a normal credit card would be. But there's also fixed second mortgages. So it would not touch your rate on your first mortgage. You'd leave that alone. And then you'd use the equity. Usually it goes up to 85% of the home's value. Some people go up to, that I work with, go up to 89.99% of the home's value. So just an example, right? If you owned a home and it was worth $800,000 and you took 89.99%, and then you had a mortgage of $600,000. That's, so it says you have $119,000 available that you could get an equity line if you qualify. So, yeah. So those are people.
So what's the rate? What's the rate?
So the way that second mortgages are factored is it's the prime rate, which the Fed sets. So the prime rate as of today is 7.5%. That's the starting rate for everyone. And then what happens is there's a margin that's added on top of that depending on your credit score, depending on your equity position. So it could range. It could be from 8.5% to 10.5% to 12%. It just will depend on everybody's situation individually.
But it's still lower than the credit card.
It's still lower than the credit card. And if you use it for home improvements and you could document that, you could still potentially get a write-off on the interest on the second mortgage as well as your first mortgage. But people are using the equity. I do a bunch of second mortgages or equity lines or HELOCs, or they're called so many different things, because people see an opportunity in the market right now to buy investment properties. So they're pulling equity out of their existing home. They're going to their real estate agent like you, and they're buying a fixer-upper, or they're buying an investment property or something, because otherwise your money is just sitting in your house.
Yeah,
You
exactly.
interest, not, it's sitting there, so you could pull it out and invest it into something else.
One question about this line of credit. You're gonna pay interest rate starting at the closing, or when you take the money out, you start to pay the interest rate as you?
So some of them have a minimum draw that could range from like 50,000, meaning whatever line you take, you have to draw 50,000 at the beginning, but then you could pay it back because there's no penalty to pay it off early. But so whatever balance you end up having remaining, you would pay the monthly payment off of that balance. Some require you to take the whole draw up front, right? So if you wanted 200 grand, you're going to get 200 grand, but whatever you don't use, you could reapply back to the loan and they'll readjust the payment based on your new balance. But
okay, that's nice.
Go ahead.
Okay, talking about the rates. Let's get back to the rates.
Yep.
Where are the rates today after they released the US inflation data? What did you see? What do you think?
So
what are you expecting? I know we don't have any magic ball or something, to tell people.
I wish I did. I would be rich if I could tell you what rates are going to do. But there, I mean, like the loan I priced. I mean, I priced a loan for someone today that they were in the mid 6s. I got an FHA loan price today that was in the mid 5s. So there's still decent rates. I mean, for me, they've dropped below that 7% mark on a lot of different products. When it's really hard, right? Because they're going to continue to raise rates and try and slow the market down until inflation is in check. That's just, they've said that that's what's going to happen. The good news is though, it's starting it's starting to come into check, right? It's starting to get better. So you're not seeing as big of a hike, or like it's kind of slowed down a little bit, which is good news, right? So I'm hoping the next Fed meeting is in February. We'll see kind of what that data looks like. Today we got a little bit of an improvement actually in pricing, which was good news. And so it changes every day. I wake up every single morning and I have no idea what's going to happen.
What's going to happen? How the day is going to be like.
So, and that's what I tell people is like, I don't watch the news. I don't want to hear the negativity. I don't want to read about it. People have been buying homes for as long as we've all been living, right? And you're going to have a death, a divorce, a family, kids leaving, parents having to downsize. There's always a reason, a life event for people to need to buy, right? Investments. So what's funny?
What's funny, Tracie? Most of my clients, and even me, you see, I am asking about the interest rates, but a lot of us, we are living in rent, right? And we pay 100% interest rate by living in rent, but we worry that the rate tomorrow is going to be 0.5%, higher. It's funny, but we are just like this.
And that's what I tell people. It's like you're in a mortgage. When you buy a house, right, you're in the house. I mean, you're probably going to stay there on average, 2 to 5 years. In a mortgage, if all of a sudden you're in a mortgage and 8 months from now rates drop, you refinance. Like, you don't have to be stuck in that loan. If you can qualify to refinance, there's no prepayment penalties. So, if let's say, for example, you were in a house and 2 years from now, the rates dropped. You just earned 2 years of appreciation. and paying your own mortgage down while you still have the opportunity to get into a new rate. And something cool with my company is, like, if you refinance, you don't have to go back to 30 years. They have options that you could go to 28 years, 26 years, 24
or 15
years.
years or 10
Whatever you
years.
want. Any amount of years that you want, we could do it based on, like, if you don't want to roll it back out to 30 years, you don't have to.
You know, I think people, they didn't forget about 2008, 2009. So maybe that's why they are so scared, you know, and everyone is like afraid of committing. Because I got a lot of my clients which they are asking me, you know, if it's again the crash of 2008, you know, and I'm trying to explain them that it's totally different today. Because, you know, I just got in the real estate as a licensed realtor at that time, but I had my own investments and I saw, you know, what was happening on the market before the crash. Right now, it's totally, totally different, you know.
Yeah.
People right now, they have, a lot of them, they pay their homes off, they don't have mortgage. A lot of them, maybe almost 30%, something like this, they have a lot of equity in their home, like 40% equity in their home. So
I can
it's
tell you
totally different.
the biggest difference, and again, like, look at historical data. The reason in 2008, there were so many homes, new homes built in 2006, right? That there was so much inventory that between that and then having the mortgage products being stated income, not, you know, no income, no ratio, I get it, but stated income with like no down payment were mortgages back then, right? People were going into reverse mortgages, into neg-am mortgages. It was a whole different process where
And the appraisals, they were very, very flexible.
now you have to qualify. You have to have the income, the down payment. We're looking at everything. You're documenting pretty, like, everything, you know, so, and the inventory, there's still demand, right? So
2004, I bought a house. So the contract price was 350. Appraisal came in at 450, so 100,000 more. And the bank asked me if I would like to have 80,000 line of credit. So, you know, I left from the closing with the key for the house plus 80,000 in my pocket. And I think, you know, this was one of the reasons we went down that much at the time.
People couldn't afford the payments, and then there was so much inventory that
nobody asked me if I can afford, you know. They just asked me if I want money, you know, and everyone was like, why not?
Yeah, it's so different now. And I mean, you could see obviously the appreciation in the market during 2021 and 2020, no, last 2020 and 2021, where it's like on average over 14%. That's not real either. You know, I mean, in my market, we're like on average like 4% a year. What is your average appreciation in your market? Do you know, per year?
You know, depends from area to area, but it is true. Some areas, you know, even 20%.
Wow.
We have areas with 20%.
Okay.
But guess what? Those money came from the buyer's pocket. They didn't come from the bank because the appraisals, they were so strict.
Yeah.
They didn't give that much value. So, you know, and a lot of, because it was so crazy competition with like 40, 50 offers on a home, you know.
Yeah.
The winning offer, they removed the appraisal contingencies, so they had to come up with the money.
Well, now that's right. Buyers are more protected now because they don't have to waive their appraisal contingency or their loan or their inspection. They were just going in blindly and saying, just give me the house. It was like a buying frenzy. It was something I mean, I've been in this business for a long time. In the last few years, we're like, I swear, it was like we were living in an entirely different world, you know?
Yeah, especially, you know, when when the COVID, you know, hit first time, you know, I was like, oh my gosh, you know, I had some clients, they were calling me, asking me if it's a good time to invest, to flip homes. And I was like, I'm so sorry, you know, I never had this situation. I never seen something like this before. I don't think that it's a good time to invest right now. Just wait a second, you know, a month or two to see where we're gonna go. Guess what? Some of them, you know, they went to another agent and they bought a property and they flip it and they sold it in the fall and they make profit.
Yeah.
And I was shocked because I didn't expect this to happen.
Yeah, you just don't know. And it's people's
Yeah.
money, and we are, I mean, that's our jobs, but at some point you also have to let people make their own decisions, right? I'm not going to make the decision that you're going to buy a house or not, but I could just give you all of the information and you make that determination based on what's right for you.
Yeah, but it was so scary at that time because we didn't have that situation. Never, ever in my life. I didn't see something like that and I didn't know where the market is going to go.
Yeah. And me too. I never had a situation where rates went from 3% to 7% overnight. I was like, what happened? I mean, I just wanted to crawl in a corner and like be like, but you know, it's again, it's part of our job, it's part of our business, and we just have to educate people. And you know, when people are ready, they're ready. But you know, I think that it's still a good time to buy, like you were saying, and you know, there is still inventory out there, and so
yes,
hopefully
yes, it is. Okay, thank you so very much. I know that there are many questions which we didn't go over. I'm sure we will answer them in the next session.
Yeah.
So
and
until then, I'll invite everyone to put their questions in the comments or send us a message.
That's what I was going to say. Yeah, if you want to put them in the comments or reach out, you can see, I mean, my phone number has been up there. You can message me on social media, you know, obviously talk to Daniela and see kind of what your goals are. And then we could do like a little consultation. And it was so nice to talk to you. I loved it. So I appreciate it.
Thank you so very much, Tracie. It was very nice to talk to you. See you next time.
Okay. Bye.
Bye-bye.